It's common financial wisdom to have a diversified portfolio, and if you want average returns, that wisdom may be correct. But who wants to be average? Hey everyone, welcome back to the channel. My name is CJ, and today I want to talk about why I run a concentrated portfolio. In this video, I'll cover my definition of a concentrated portfolio, the logic behind why I use this strategy, some golden rules for focus investing, who should consider a concentrated portfolio, and some of the potential risks of this approach. Please like the video and subscribe to the channel if you find this information useful. And please remember that this is not investment advice. This is what has personally worked for me. There will be timestamps in the video description if you want to jump around to any point in this video. Okay, let's dig into it. So what is a concentrated portfolio? Depending on who you ask, concentration can mean a ton of different things. Some investors may call a 50 stock portfolio or a 20 stock portfolio highly concentrated. On the other hand, Charlie Munger has said that owning one stock is enough. Warren Buffett has publicly said that he is very comfortable holding one stock in his portfolio. And Mohnish Pabrai has recently said that in his personal portfolio, he holds 2 to 3 companies max. So who's right in this scenario? Is one company enough to consider yourself diversified, or should you invest in 100 companies? For me, I would say that I never want to have more than 10 stocks in my portfolio. My top 2 positions make up 60% of my personal portfolio, and my top 3 positions make up 70%. Right now, I would be much happier if my top 3 positions made up 100% of my portfolio. So you can probably guess that I'm totally in Warren and Charlie's camp. I believe having one good business in your portfolio that you understand extremely well is enough to carry you to the promised land. This extreme approach may not be for everyone. I may be on the extreme end with Warren and Charlie, and perhaps it's just the way I'm wired, but I do believe that there's a way we can capture the benefits of a concentrated portfolio without only investing in one stock. I recently discussed the success of Nick Sleep's approach, where he held about 70% of his portfolio in 3 companies, which were Amazon, Costco, and Berkshire Hathaway. He basically sat on his hands for a decade and just watched his positions grow. Amazon carried him to the promised land, and Costco and Berkshire Hathaway are nothing to sneeze at either. Buffett has said that with each investment you make, you should have the courage and conviction to place at least 10% of your net worth in that position. I frankly totally agree with him. I think building a 10 by 10 portfolio is a good place to start if you're looking to concentrate your portfolio. And what I mean by that is you take 10 positions, all making up 10% bets. For most of the history of Mohnish Pabrai's fund, he has made bets of sizes in 2%, 5%, and 10% increments. And these bet sizes were all based on his conviction. So I'll place a cap at 20 positions. So if you're not willing to hold 20 or less positions, then concentrated investing probably isn't for you. Let me know in the comments below if you have a concentrated portfolio and how many stocks you typically like to have in your portfolio. Next up, let's talk about some of the reasons why we should concentrate. Okay, so you have some understanding of what a concentrated portfolio looks like, but why should we run a concentrated portfolio? I believe that a concentrated portfolio is superior to a diversified portfolio for a few reasons. Investing is all about opportunity cost. If I have identified a few companies that are going to outperform the average market returns, why would I invest in anything else? What are you achieving by putting money into your 50th best idea when you believe that your number 1 idea has a high probability of future success? So maybe you have 1 to 3 companies in your portfolio that you're pretty confident will be winners. Well, then the right course of action would be to put the bulk of your money into your best ideas. Your number 1 idea should be your number 1 investing opportunity, and all other investments should be compared to your number 1 idea. You need to be willing to swing for the fences if the market serves you up a fastball right down the middle of the plate. There's way less risk in owning 3 wonderful businesses than owning 50 well-known but average businesses. How worried would you be if the only companies in your portfolio were Amazon, Google, and Berkshire Hathaway? The chances of that portfolio failing are basically 0. These wonderful businesses are so wonderful in the first place because they have competitive advantages. From a competition standpoint, it's really hard to take down these entrenched businesses. According to Charlie Munger, if you're a know-something investor who's willing and able to spot missed price opportunities in the market, then you're actively hurting yourself by looking at 50 opportunities when really 1 to 3 will do. In my view, a concentrated portfolio is way less risky than a diversified portfolio, because it increases the intensity with which you analyze the business and the economics of that business before investing. If you're only looking at a handful of businesses, you should be able to understand the intrinsic value of those companies with a lot more confidence and accuracy than if you were looking at 50 companies. Basically, in my view, the more you know about your company, the less risk you're taking. I'll talk a little bit more about risks with concentration later on in this video, but the broad rule for concentrated investing is put all of your eggs in one basket and watch that basket. Also, I don't want to own a company that I don't understand. I don't understand 99% of the companies out there, and that's perfectly okay. I'm much more comfortable owning a few companies that I can understand really well. Remember that I'm betting on the likelihood that the company will do well in the future, not whether or not the stock price is going to go up or down tomorrow. Fortunes in business aren't built on a portfolio of 50 companies. And it's the same way in investing. If we think about ourselves as part owners of the businesses we invest in, then it's pretty easy to understand why concentrating makes more sense. Did Jeff Bezos diversify when he started Amazon? How about Sam Walton with Walmart or Mark Zuckerberg with Facebook? Entrepreneurs who never sell are the best investors, and they're heavily concentrated. And finally, investing for me is just a wonderful challenge. I want to beat the market, and I believe that the best way to beat the market is to hold a handful of companies. I can't beat the market by mimicking the market, so I'll try to spot a few mispriced opportunities and bet heavily on them. Now let's move on to some of my ground rules for focused investing. Oh, hold on a second. If you're enjoying this video, please like the video and subscribe to the channel so you can stay up to date with my future videos. Okay, back to the discussion of concentrated portfolios. There are some ground rules I learned early on about focused investing from the book The Warren Buffett Way, which you should totally check out. There's a link to that in the description below. From that book, I learned 5 general rules about running a concentrated portfolio. The first is we need to concentrate our investments in outstanding companies. So basically, we need to make sure we're making big bets on the no-brainer opportunities that fall on our laps. This concept is pretty simple to understand, but it's not necessarily simple to find these companies in these opportunities. But sometimes it is. Apple was hiding under the nose of every single investor in 2016 when Buffett invested. Next up, we need to limit ourselves to only investing in companies that we can understand. This goes back to what I was saying earlier about being happy with only one company in my portfolio. I may not be the sharpest tool in the shed, but I believe that I can understand 1, 2, maybe 3 companies really, really well. Fortunately, it doesn't take a rocket scientist to understand one company really well. And fortunately for us, that one company can possibly make us very wealthy. I bet for most people running a concentrated portfolio, 10 companies is a sweet spot, and anywhere beyond 20 companies or so is probably pushing your portfolio into a diversified zoo of companies that you don't really understand fully. Number 3 is where opportunity cost comes into play. The rule is to pick your very best idea and put most of your money there. Why would you invest in your 10th best idea if your first best idea is a no-brainer sitting there right at your fingertips? Theoretically, your number 1 idea should have the highest probability of playing out favorably in the future, so I'm gonna bet with the odds. The next rule is that we need to have a long-term time horizon. Even in great businesses, there can be short-term setbacks or underperformance based on Wall Street expectations that can negatively impact the stock price. There are also tons of psychological pressures that can affect us, such as seeing other opportunities grow around you while your position isn't moving. But over the long term, the value of the underlying fundamentals of the business should be reflected in the share price. And the last rule is that volatility is the name of the game, so don't panic. Volatility is the little devil on your shoulder always telling you to buy and sell at exactly the wrong time. If you can't handle wild fluctuation in a stock price, you probably shouldn't be in focused investing. Remember that the intrinsic value of a company rarely fluctuates as much as the share price of that company. In March 2020, Amazon's share price took a nosedive when it arguably became more valuable as a company due to the pandemic. That doesn't make any sense. The right thing to do is seize volatility as an opportunity instead of fearing it. Volatility can serve you, so don't give in to the fear. You may be sitting here listening to this thinking, wow, he's crazy, or he has a ton of risk tolerance. And maybe you're right. Concentrated investing isn't for everybody. So let's take a look at who should be concentrating. Warren Buffett refers to the average investor as a know-nothing investor. That term isn't meant to be derogatory. I shouldn't be offended if a professional surgeon calls me a know-nothing doctor. Buffett says that diversification is a protection against ignorance. He also said that if you want to make sure that nothing bad happens to you relative to the market, then you should definitely diversify. This may sound kind of harsh, but if you think about it, not everybody is going to be an above average investor. In fact, it's literally impossible. Not everybody wants to or cares about managing their portfolio. Not everyone knows or wants to learn how to value and analyze businesses. If you're not well versed in investing, in analyzing and valuing businesses, then you shouldn't expect above average returns. Diversification is a perfectly acceptable way to go. In fact, most passive index fund investors are going to vastly outperform the majority of professional active managers. So if you're not willing to put in the time to analyze or value businesses, which is perfectly fine, what I would do in your shoes is simply invest in an S&P 500 index fund, bet on the long-term prosperity of the United States or whatever country you're living in, and focus your energies on something else. If you stick to this plan, chances are over the long term, you're going to become extremely wealthy. But if you can and are willing to analyze and value businesses on your own, you should definitely concentrate. Okay, let's talk about some of the perceived risks of a concentrated portfolio. One of the most obvious risks is pretty simple and straightforward. If you analyze a business incorrectly or pay way too much for it, it's likely that your investment will not outperform the market. In a worst case scenario, you could lose a big portion of your wealth because you're putting so much of it into one position. However, this goes back to one of the golden rules of focus investing, which is that we should feel quite certain about the future prospects of the business that we're investing in. Hopefully that will mitigate and prevent huge losses. So if there's another market downturn again, like in March of 2020, how comfortable would you feel if the majority of your portfolio was invested in Amazon or Google? I know I would feel pretty good about it. So I try to get my investments to a point where I would feel indifferent if the market goes down because I know how high quality the businesses are that I'm invested in. Another notion of risk is something that I stole from Buffett, but it's my definition of what risk is. Risk in investing is the chances of permanent loss of capital, not volatility or beta. The main benefit of diversification is to dampen the volatility of your portfolio, but I'm not concerned with volatility at all. In fact, I welcome it. If I truly understand the business, then I should be happy to have the opportunity to buy that business back at a lower price. But for most investors, the most difficult part about running a focused portfolio is not the fact that we have to decide which businesses to invest in, but it's how do we handle the ups and downs of those businesses. We have to have the mental fortitude to handle the volatility in these businesses. From a psychological perspective, we have to handle the swings in the market. And the best way to determine whether or not you have that fortitude already is to start investing in the market. There will inevitably be a downturn, and then you'll be able to see how you'll react. It's difficult to do that with a simple thought exercise, but you can try that as well. We can also suffer from the grass is always greener syndrome. You may see other investments inexplicably skyrocketing, Tesla, and you might start to second guess the investments that you own in your portfolio. It's human nature, but don't give in to it. Reassure yourself by verifying the fundamentals of your thesis. And if those fundamentals haven't changed, then the prospects of that business haven't changed either. If you invest with the appropriate time horizon for years or a decade, not for days and weeks, we can mitigate the risks of our investments. If we believe we can predict the future prospects of a business with a high degree of certainty, then over the long term, which could be 2 years or 10 years, the chances of that prediction playing out favorably will be a lot higher. I'll sum up the idea of focus investing with that quote that I already said in this video, which is, put all your eggs in one basket and watch that basket. Since you made it this far, you may like this video over here where I talk about Monish Prabhai's new investing approach. If you found this video helpful, please like the video and subscribe to the channel so you can stay up to date with my future content. Thank you so much for watching this all the way to the end. Let me know in the comments below if you have any questions or concerns about a concentrated portfolio. Thank you for watching, and I will see you next time.